So deal sourcing is actually the process through which venture capital firms identify potential investment, and it's literally the lifeblood of venture capital.
But you see, one thing that tends to bite the most, especially for VC, is missing out on that startup that is going to be the next big thing. Because, based off on the operations of the power law, one particular startup might be the startup that returns your entire fund.
We're having a consensus approach, and we're investing in whatever everybody is investing in.
Yeah.
So, to be honest, if you are taking a contrarian approach in startup investing in Africa, um, in 2025, we would have better deals, to be honest. I want to mention something. Sequoia, Sequoia is one of the largest VC firms in the USA. So they've had 99%. So 99% of all their startups are either alive today or they've gone public. Like they're still running today or they've gone public because most of their approach is very contrarian. Like they're like first mover into every first industry, right? So right now their investments are into quantum computing. It doesn't even make sense right now. But I would say thank you also for writing this book. I think it's one of the most important books that I can recommend for anybody starting, wants to have a career in venture capital. And beyond that, like in private alternative investments.
You're welcome. So, guys, as our tradition has been for the past couple of weeks, we are doing a book reading of the book 365 Days in Venture Capital, a guide to the business of venture capital in Africa. And today we are going to be looking at chapter 3 of the book, which is on deal making, emphasis on deal sourcing, right? You hear people talk a lot about sourcing deals, especially for instance, if you're like an analyst or anybody working in a VC, this deal sourcing is a critical aspect of the job function. So today we are going to be doing a deep dive into deal sourcing, and we have the best person for the job, and that's Mr. James Okpare. So before we get started into looking at the book, I would like to ask Mr. James, please just introduce yourself, tell us a bit about yourself and your background.
Yeah, so thank you, Miracle, for having me. I would say thank you also for writing this book. I think it's one of the most important books that I can recommend for anybody starting, wants to have a career in venture capital. And beyond that, like in private alternative investments, because venture capital is private alternative investment. Private equity is private alternative investment. So this book is not just good for venture capital, it's also good if you're starting a career in private equity, actually. So I want to say big thank you. So my name is James, and I'm currently working in BC in venture capital, right? I work with Grown Studios, Grown Venture Studios, which is a venture studio. That's where I started my venture capital career. I did a couple of work with Microtraction. Then currently I'm actually a deal partner with Ghana's Venture, but helping them deal source deals in Africa. That is a short introduction about.
All right, thank you very much. So, guys, like I said, this is the best man for the job. So, before we get started, chapter 3, just reading a part of the book says venture capital is 101% risk loaded, but finding winners can make it less risky. This chapter guides readers on how VCs find investment opportunities, drawing attention to the tips, tricks, and challenges and how to overcome them. So, James, I think the first aspect for us is to try to understand what deal sourcing is all about and why it is important. We know that venture capital is high risk, high reward, and to a large extent, you tend to mitigate your risk at that beginning phase when you're able to identify great companies, we're able to identify great winners. So that puts deal sourcing at a very, very critical part. So, from your own point of view, just talk to us, what is deal sourcing all about and why is it important in the operations of a venture capital firm?
Yeah, so thank you very much. So deal sourcing is actually the process through which venture capital firms identify potential investments. It's a way to evaluate investments and acquire potential investment opportunities. And it's literally the lifeblood of venture capital. It's actually what makes venture capitals precious as an asset class because most of the deals in venture capital are mostly tech startups that we kind of like have as deals, but it's a lifeblood of venture capital because some of these tech startups can actually go to be unicorns or hundreds of dollar worths of businesses and all of that, right? Let me give you a statistic as well. For example, Amazon, Google, Apple, Facebook, they were all venture backed startups at a point. And these are companies worth minimum of 1 to 2 trillion right now, right? These are all venture backed startups at a point, right? So deal sourcing is crucial because you have the potential to actually identify the next great businesses of the world. But if you if you if you don't have an eye for deal sourcing, you might not identify like some of those great businesses, right? So it's very important for VC as an asset class.
Interesting. I think you raised a very, very critical point, right? And that has to do with finding the best companies out there in the market. And
Yeah.
yes, it's quite known that many startups will end up failing. But you see, one thing that tends to bite the most, especially for VC, is missing out on that startup that is going to be the next big thing. Because based upon the operations of the power law, one particular startup might be the startup that returns your entire fund. Yeah, so it doesn't matter how many other checks you have written, but that one that you tend to miss can flip the fund performance the other way. So makes a lot of sense. So this due sourcing is very, very critical. Now, a lot of conversations around. So now we know that VC due sourcing rather is important in VC. Now, the next part of the book that was discussed is in terms of what are some of those key considerations when sourcing deals, right? And there were three aspects that were touched on, and I would like you to just expand on that. So the first one, investment mandates; the second one, market trends; and the third one, knowing the different pipelines for deal sourcing.
So investment thesis is actually outlining your preferred sector, your preferred stage of where you would actually invest. If it's on the early stage side, if it's on the pre-seed or late stage or growth stage, which is like mostly the Series A, the Series B, the Series C. And also the geographical location is actually part of the investment thesis, right? But I think in everything, I would say that the sector is actually very important in the investment thesis because in each geographical location, some sectors might differ in terms of which sector is valuable. For example, in the context of Africa, where we have like, or in the context of Nigeria to be more precise, where we have 200 million people, a sector like financial services, unlocking financial services for 200 million people is very valuable because these 200 million people will be able to do commerce effectively, will be able to move money around, and will be able also, in some cases, get remittance more effectively, right? So sector is very important. You have to kind of like look at the sector that has the biggest tailwind behind it. So tailwinds, I'll simplify what I mean by tailwind. But tailwind is mostly where the wind flows, where you will see where the wind flows in the sense of where's the next big shot gonna come from, right? The biggest tailwind happening right now is artificial intelligence, right? And most of the investment thesis had to change just because of this one tailwind happening, right? Every investment thesis in the USA has changed. Every VC investment thesis has changed. Everybody is investing in artificial intelligence because it's going to cut across different sectors of the economy and all of the stage at which you invest in your investment thesis also matters. On the seed stage or on the early stage for most companies, it's great. It will function as an incubator where you actually incubate startups. For smaller funds, most of their stages would be seed or pre-seed, very early stage companies, and that's where they would invest in like early stage companies, right? So because of the size of the fund, basically, right?
Okay. I think
You want to say?
yes. I think you touched on something very critical about breaking down what tends to form investment thesis. So you made mention of the industry of focus, you made mention of the stage of focus, and that's to a large extent impacts on deal sourcing because you have a fund size and you have a particular amount of money that you want to deploy. You possibly cannot deploy capital into every startup in the market. Yeah, and you do not have the capacity to source or to better review every opportunity in the market. So investment thesis kind of narrows your focus or stream is maybe a better word would be streamline your focus into
Exactly.
kind of companies that you are looking at. And then you also touched on something that already speaks to the second aspect that we talked about, which is industry and market trends. Now, when we're talking about tailwinds, so a particular market trend that cuts across every aspect now is artificial intelligence. People are talking artificial intelligence. People are talking about generative AI, and somehow that it's now impacting on the sort of startups that this is investing to based off on the fact that okay, with this being the market trend, it's possible that the next winner is going to come from these aspects, right? And then you also talked about the part where it's you are now it's guides which aspects that you're looking at. So for instance, now if you do pre-seed you do pre-seed kind of investment, you most likely will be having some sort of deal flow partnerships with accelerators, incubators, because these are the guys that tend to work with pre-seed startups a lot. So I think that creates a natural flow into the next question that we are going to be looking into, and that is where do deals the deals for VCs tend to come from. And here we evaluated the number, we looked at referrals from other VCs, collaboration with accelerators, events and conferences, partnerships with angels and angel syndicates, referrals from other entrepreneurs like startups within the portfolio of that VC, and then also collaboration with venture studios. You made mention of working with Grook's venture studio at the very start of your career. So let's look into these different pipelines, these different aspects where deals come from. What are your thoughts about them?
That's right. So conferences is actually one of the best places to actually get deals, right? But um, some of the best deals actually comes from I would just say plainly luck, to be honest, right? Because if Paystack approached you in 2015 to be one of their first outside investor, like you you hardly see Paystack as just a random other startup, right? But today, fast forward today, you'll be so lucky, right? Some of the best deals comes from unexpected places, right? They can reach out to you. It's a formal relationship with a friend. Um, but yeah, but typically the deals that I see happening right now is mostly participation in other fundraise. Basically, that's how people have access to most deal flow to be these days, right? Uh, so I see it.
So that's quite spot on, right? Because like you mentioned, um, it's mostly hard to say you want to build, let's say, a model as to where the right deals tend to come from, right? So
Yeah.
they could come from different pipelines. That's why it's important sometimes to cast your net wide. So you see, as attending conferences and speaking with founders. But then again, what you tend to find again is that many times deal sourcing is relationship driven. That a lot of the deals that VCs eventually do is more driven by referrals. So referrals from either other VCs or referrals from known relationships. In fact, there's this particular data that we looked into in the book, and breaking out different sources of deals that this is eventually do, and you realize that 30% tend to come from referrals from former work colleagues of and this gotten from Harvard Business Review, that
Yeah.
30% of deals come from referrals from colleagues or work acquaintances of those that work in this is maybe the partners in the firm. Then 20% comes from referrals from other investors like other venture capital funds. 8% comes from referrals from existing portfolio companies. So the portfolio of startups that the VC already has, some of them recommending other founders to the VC. Then initiating direct contact with entrepreneurs.
Yeah.
About 30% of that comes from there. Then cold email pitches by company managers. So maybe the VC, the startup founder itself, himself or herself, reaching out to the VC for funding. So that's about 10%. So you realize that when we sum up that of referrals, we see that more than 50, about 58% of deals that VCs do tend to come from referrals and relationships. So can you just briefly, what are your thoughts around why everything is mostly relationship driven within the VC space?
Yeah, because it's simply because to entrust someone with your capital is risky, right? So you need to know someone before giving something to that person. To be honest, like I think that is the way it happens in marriages. Most VCs tend to see venture capital investment as weddings, as marriages, right? There's a courting period where you date the person to see if it's a potential fit, if the person matches your value system, before you can actually commit to that person, right? It's the same thing with investments. Like generally all investments in life, like from your first angel seed, from an angel investors, it will literally be because of relationships. Like 99% of angel investments, like random angel investments, has been because of relationship. And most of those angel investment comes from family and friends, first of all. Right. That's what we call it a family and friends round. And going forward, you kind of like have to establish relationship with venture capitalists. And that is why it's very important to know these people and know these people as friends. Like outside work, like by playing football with them or tennis with them or becoming their friends long term. And I mean, they'll take notice that, oh, you're actually building something, right? And that's how they will open the door for you to pitch your idea to their VC firms. And that's how you will most likely get an investment, right? And some is actually because of former employees at reputable companies that have actually raised money. They, they go later on to start up their startups. They would actually get recommendation from their former bosses who raised money from ABC firm, right? I think the best example right now in Nigeria is Chowdek. So Chowdek is a former Paystack engineer. I don't know if he was an engineer or something, but he was a former Paystack employee. He left Paystack, but it was so easy for him to raise money because his former boss, which was Shola or Paystack, raised a lot of money and got a huge exit, right? So that person can actually vouch for him. So there was a relationship before. That's how Chowdek was able to move from 0 to 1 in a very short time frame, right? So that's the reason why relationship is very important.
Insights. Now there are a lot of conversations, especially when you speak to certain people working within the VC space and analysts. They tend to we see a lot of complaints around. Okay, there are few quality deals in the market.
Yeah,
Um,
that's true.
and again, let me not say no things, but some of them is traceable down to some of the buoyant outcomes we saw in 2021. So for that reason, many people just started doing something just so that they can raise and make announcement that they raise capital. So there are conversations around quality of deals, but why do you think that let's say deal sourcing could pose some challenges for people, let's say VC or somebody working in VC in within Africa? So a number of aspects were mentioned, one of them being the pulse of deal activity, the second one being low quality deals, and then the third aspect being macroeconomic challenges. Now on the pulse of deal activity, certain ecosystems were compared, right? That if we look at it, we may be putting so looking at it, so for instance, it's estimated that the total number of startups in Africa should be fewer than 8,000, considering that the big four African market will represent the majority of startup activity. collectively reported about 5,690 as of 2022. So now, if we want to compare that with other ecosystems, we see like a wide margin. So if you look at Asia, for instance, 9,000 active startups, Singapore, 4,500 active startups. Then if you look at India, for instance, about 127,000 active startups. So clearly the deal activity in Africa, it's quite small compared to other ecosystems, right? So what are your thoughts around the pulse of deal activity in Africa, and low quality deals, and then the macroeconomic challenges that are impacting on deal sourcing?
Yeah, so that was a very good point raised. And the way I want to answer this question, if you look at 2015 to 2020, before 2021, look at that period. If you were in Nigeria at that time, you would see a number of startup hubs organizing hackathons, organizing tech startups, tech seminars and conferences. But mostly on the hackathon side, where you saw Google developers community,
Yeah.
Amazon developers community. Like you saw how they were active around those period and trying to build the next set of developers, and all of that. Those period were building phases for Africa, and those period actually contributed to the emergence of startups like Paystack, Flutterwave, Piggyvest, RiseVest, Bamboo. It was in those periods that those startups emerged because, to be honest, back then, every time, every week, there's an hackathon in Nigeria. There's an hackathon in Lagos. There's an hackathon in Abuja and Port Harcourt, like every time, right? And that, to be honest, contributed to the reason why we had quality deals. Literally after 2021, everybody started focusing on VC investments. Like left hackathon, we left hackathons, we left accelerators. We started focusing on VC investments because 2021 blinded our eyes as to how startups work. Basically, we're like, oh, we raised money on an idea, and we raised tens of millions of dollars on just an idea because in 2021 we saw that happening, right? So literally quality of deals literally went down because everybody were focused more on the money, trying to get money from investors. So they would just repackage another fintech idea to present it to investors, right? And investors have a fiduciary duty to deploy that capital within a particular time frame because they have a duty to report to their limited partners that, oh, we are going to deploy $5 million or $10 million this year. So VCs have a responsibility to deploy that money. That money will be allocated. So if they don't find good deals, they will definitely allocate it to shitty deals. And if there are more shitty deals, and money has to be allocated, then money will be allocated to shitty deals, right? The other reason is because that I feel is because we became more consensus than contrarian. So I'll say this way: in 2015, fintech was not popular. Um, like startups generally were not popular, right? But let's say fintech in general were not popular. So we're really contrarian to go against the conventional type of investments to invest our first checks in fintechs. The first checks was given to Paystack or Paga or Flutterwave, and we're really contrarian back then, right? In our approach. Right now, we are more consensus, meaning that everything that is working right now, we'll invest in those things. So fintech has been working, we'll invest in fintech, right? But 2015, there was nothing like fintech, right? So we took a contrarian approach to invest in fintech. But right now, we are having a consensus approach and we're investing in whatever everybody is investing in.
Yeah.
So to be honest, if you are taking a contrarian approach in startup investing in Africa, um, in 2025, we would have better deals. To be honest, those deals will manifest in the next 3 to 5 years. That these were the right deals taken in 2025. They might not appear to be like that because contrarian approach is always like that, right? Why would you invest in let's go beyond Nigeria, right? Why would you invest in OpenAI in 2015 or why would you invest in Facebook in 2004? Well, like, why would you do that, right? Why would you invest in Uber in 2007? Like, those things didn't make sense when it was the first check given to those companies, right? It was very contrarian decision making taken by VC folks, but they appear to be the best startups. So the best startups typically are mostly contrarian approach. I want to mention something. Sequoia, Sequoia is one of the largest VC firms in the USA. So they've had 99%. So 99% of all their startups are either alive today or they've gone public. Like they're still running today or they've gone public because most of their approach is very contrarian. Like it's very, they're like first mover into every first industry, right? So right now, their investments are into quantum computing. It doesn't even make sense right now, but it will make sense. It might make sense in the next 10 years that it or the right.
I
Go
think
ahead.
like you raised a very, very important point here, and it has a trickling effect on many things that rather than being contrarian, as we used to know about VC, we're now being more consensus based. And that consensus is now also affecting the sort of product that we're having in the market. So if the consensus is tech, every entrepreneur coming into the pipeline wants to build a fintech product. Every VC that wants to
Exactly.
raise a fund would definitely have a fintech investment thesis, right? And what you now tend to find is that with the products that we now have is with very, very little differentiation. So that also blinds the eyes of people from, let's say, some people that are building great products in areas that are not really
Exactly.
answers, right? Because I know a lot of times then a lot of times if in healthcare, for instance, is that most of the deals are telemedicine, 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 telemedicine after COVID-19 happened, and it's kind of brought healthcare to the forefront. But when you start seeing things like when you start seeing things like precision medicine and all of that, people don't want to pay attention because
Bio.
quiet. Nobody wants to into that. So that's very, very key. Now, what are some of your thoughts as to tips that is going to help um um get a person get better in deal sourcing? So a number we mentioned here, being able to sharpen your investment thesis and stay on track. Go. So what are your thoughts around tips on getting better at deal sourcing?
So I would say go for quality over quantity. See, quantity matters, right? Like because 9 out of 10 venture-backed startup kind of like fail, right? And the power law is that one would actually cover for the most returns that the nine couldn't provide.
Yeah.
So, but that will be found in quality. So if you have more quality in that quantity, is even better, right? Um, the other thing I would say is venture studio also are very important in the African context. So macroeconomic factors that we mentioned is actually affecting a lot of things. Yeah, even valuations, to be honest, because nobody would actually buy in Nigerian or let's say Nigerian startup that makes revenue in Naira because of our valuation, right? Nobody will want to buy that company in dollars because of our and the valuation is priced in dollars. There's a premium on that valuation, like it's like a Silicon Valley type of startup, right? So, but that's why the venture studio model is very efficient right now. And I would say most BC firms should actually look towards having a venture studio arm or getting towards like the venture studio model of being exposed to it, have exposure to it, right?
Very.
So I would say this is actually one of the best ways to.
Okay, so for you, in terms of stepping down to look at the venture studio model, especially based off on that aspect of venture building that venture studio tends to bring to the table. If we talk
Yeah.
about maybe many founders don't know how to build, so venture studio kind of creates that platform to help entrepreneurs build,
Exactly.
right? And I think there is a stat that talks about that the graduation rates for venture studios are better than venture capital, like people that didn't go through venture studios. And then even the chances of exit are even better for venture, for startups coming out of venture studios, right? And I mean, a number of aspects also talked about is strengthening partnerships and collaboration. So for a VC that may not be able to, let's say they don't have the capacity, the financial capacity to, because it's going to take a lot in terms of cost to run a venture studio. They could have that sort of partnership and collaboration maybe with another venture studio out there. So then we also talked about referrals. Now the last part that I would have loved to talk about, but we are out of time, is in that aspect of back office operations, deal pipeline management, right? So I mean, a CRM tool, a CRM tool here is usually important to managing um due flow so that you're able to track all of that. But we don't have time. We've run out of time for that aspect. So, James, thank you very much for coming on board and spending the last 40 minutes with us.
Sorry, invited.
Yeah, you're welcome. So, guys, you're welcome. So, guys, the book is 365 Days in Venture Capital. You can get a copy at www.365daysinvc.com. It's also available on Roving Heights on Amazon. So, you do well to get your own copy. And yes,